It is estimated that every single year, retail traders in the United States alone are losing $34 billion in bad trade execution. This is mostly due to front-running based on payment for order flow. Front-running is one type of toxic trading, adverse selection is another. A market maker or liquidity provider never knows if someone who is accepting their trade is trading to monetize information or just wants to rebalance their portfolio. For market makers, adverse selection is a cost of doing business, and that cost is passed on to all of us in the form of a bid-ask spread and as a price impact. There is a metric to measure the degree of informed trading in a market. It's called the probability of informed trading, or PIN, and that graph here shows its volume-adjusted counterpart called VPIN. It includes the time of the 2010 flash crash. VPIN typically hovers around 20%, which means the market maker was expecting to lose on 1 out of every 5 trades. Over a couple of hours, VPIN increased and finally shot up to over 40%. The environment became so toxic that market makers simply left by selling their inventory and waited on the sidelines until the dust had settled. This caused a dramatic crash in prices, followed by a swift recovery a few minutes later. Let's see what VPIN looks like in crypto. This graph plots the probability of informed trading for the ETH market on 2 different exchanges. One of them is a centralized exchange based on an order book mechanism. The other one is the leading decentralized exchange, Uniswap version 3, implementing an AMM with concentrated liquidity. Trade toxicity on Binance is comparable to what we see in equity markets. It implements the same mechanism, the CLOB, and there is no blockchain, and there is no maximal extractable value. During the same time period, for exactly the same pair, trade toxicity on the AMM was about 4 times higher than it was on the centralized exchange. That means in DeFi, the environment is regularly as hostile to liquidity providers as it was during the most adversarial event in trading history. For liquidity providers on an AMM, the flash crash is just another Tuesday. The consequences are well known. Liquidity providers lost more than $100 million in the ETH USDC market in a single year, and that is after collecting trading fees. Now, what is the effect of this? If you look at major cryptocurrencies, the blue chips like Bitcoin or Ether, daily trading volume on centralized exchanges is routinely between 2 and 3 orders of magnitude higher than it is on decentralized exchanges. But why? Just like in TradFi, most of the trading volume in blue chip cryptocurrencies comes from sophisticated players, institutions. But institutions are cost sensitive. They have long understood these costs, and they cannot possibly justify paying tens or even hundreds of basis points to implement a single trade. For all of its virtues, such as transparency, trustlessness, and verifiability, this represents a major obstacle to the argument for tokenization of real-world assets on blockchains. Why record the ownership of an asset on a blockchain in the first place when it needs to be sent back into an opaque, centralized system whenever you want to trade? If we want decentralized finance to become the global standard, there needs to be a trading system that is resistant to these toxic trading schemes. Now, why is it so toxic? Why is it so costly? Well, there are 2 reasons. The first reason is that an automated market maker does not know what the right price is unless its liquidity pool gets adversely selected to the maximum extent. The AMM is possibly the only trading system in widespread use today where a liquidity provider can be adversely selected based on public information known to everyone else. The second reason comes down to the power of the final word. In a recent article, we analyze that blockchain trading is so costly and so prone to exploitation due to the discrete nature of their trading mechanisms. This discreteness of trading gives one party the power of the final word. On CLOBs and AMMs, this party is the liquidity taker, which is the aggressive side. With intents, that party is the filler, solver, or resolver. As long as one party has the power of the final word, that party is able to act in a toxic fashion, and they do. On blockchains, block producers have the privilege to define what trades go into a block and in what sequence. This privilege is typically sold to the highest bidder to prevent one side from protecting itself. It is the discreteness of trading and the power of the final word that provide the substrate for toxic trading schemes. Even a switch from AMMs to conventional order books will not solve the problem of high cost of trading in DeFi. The problem of toxic trading exists both in TradFi and in DeFi. It is not caused by the technological environment, but it is the consequence of a defect in the economic mechanism. It is simply exploited in a different way on blockchains than it is on a centralized exchange. So rather than trying a technical patch to mitigate the issue, we went back to economic theory to solve the problem at its root. In 2017, Kyle and Lee proposed the fully continuous exchange. In this mechanism, no value changes hands at a singular point in time. Instead, value is transferred as continuous flows over periods of time. It turns out that in this construction, no one has the power of the final word. It doesn't matter who comes first, and buying the right to be first has no value. This prevents front-running and other reordering attacks. Furthermore, price is connected to speed. If you want to monetize short-lived alpha, you need to trade fast. But the higher the speed, the more the price will move against you. This creates a public signal the market can digest and react to. Someone needs to trade very fast and is seemingly willing to do so at a very unrealistic price. That's a dead giveaway that private information is entering the market and people can react before the damage gets done. On the flip side, if you are not trying to monetize an information advantage, like most of us, Krypton allows you to credibly signal to the market by trading at a low speed that you are not dangerous. What does it look like in practice? The horizontal axis shows trading speed in US dollars per second. The vertical axis shows trading cost. The curve in the middle is the expected cost. The faster you trade, the more you pay. But there is a risk. The slower you trade, the more time the price will have to slip away from your decision price. The top and bottom curves indicate where 95% of your trades land. Trading fast comes at high expected cost. It is the devil you know. Trading slow comes at high risk of execution. It is the devil you don't know. You have to pick your poison. Krypton's front end illuminates the consequences of your choices by running a predictive Monte Carlo simulation on your GPU. We can look at the same trade-off between expected cost and risk in a familiar mean variance diagram. If you want to try Krypton, go to kryptonbeta.com, sign up, we will send you tokens, and you can be free from toxic trading and the high cost of trading.